The 8 financial sins keeping you poor even if you make good money. Hey everyone, I'm Bogdan. I want you to take a moment and think about your life right now. You're likely working hard. Maybe you've even gotten a few promotions, seen your salary increase significantly over the past 5 or 10 years. You're doing everything you were told to do. You went to school, you got a good job, and you're putting in the hours. But here's the unsettling part. Despite doing everything right, despite the high income, why does it feel like you're still running in place? Why does it feel like true wealth, true financial freedom is always just out of reach? It's a question that plagues tens of millions of people in the U.S. The American dream promises that hard work equals upward mobility. Yet, for many, that dream feels like a mirage. We look at the numbers, we look at our bank accounts, and we compare our situation to a previous generation, and the math just doesn't add up anymore. We're making more, but we feel poorer, and when we talk about this phenomenon, the conversation almost always defaults to a simple, convenient villain: inflation. And yes, inflation is absolutely crushing purchasing power. The cost of housing, health care, and education has far outstripped wage growth for decades. The Federal Reserve's policies, particularly in the post-2008 era of quantitative easing, have injected trillions of dollars into the economy. And while that kept interest rates low, it also created massive asset price inflation. It's inflating the very assets that keep the rich rich while wages lag behind. So yes, the system is rigged. The game is harder than it used to be. But here's the uncomfortable truth I need to deliver today, because I'm here as your expert friend, not just to validate your frustrations. If you want to change your financial trajectory, you can't only blame external forces. The reality is that we are all, to varying degrees, participating in a financial system that is specifically designed to transfer wealth away from the average person. It's designed to move wealth towards those who understand the rules. But more importantly, we are committing a series of fundamental, avoidable financial errors. I call them the 8 financial sins. They accelerate that wealth transfer and effectively guarantee that we remain on the financial treadmill, regardless of how fast we run. These aren't just minor mistakes. They are deep, ingrained habits and psychological traps that turn high-income earners into professional consumers rather than disciplined investors. Let me tell you about a concept I call the financial gravity well. Imagine wealth as a gravitational pull. The more wealth you have, the stronger the pull, making it easier to attract more wealth through compounding interest. The less wealth you have, the weaker your pull, making it easier to be pulled into debt and poverty. Most people live in the middle, in a state of near zero gravity. In this state, every upward push from a paycheck is countered by an equally strong downward pull from expenses and debt. The 8 sins we are going to explore today are the forces that prevent escape velocity from this gravity well. They are the psychological, behavioral, and intellectual errors that keep us orbiting the financial treadmill. They keep us orbiting when we should be rocketing toward financial independence. This isn't just about making good money, it's about making your money work for you. It's about understanding that high income is simply fuel. And without a properly constructed engine, that fuel just burns away, leaving you where you started. I'm going to break down these 8 sins, from the obvious ones like consumer debt to the insidious ones like the scarcity mindset. For each sin, we will analyze the personal impact on your wallet on a day-to-day basis. We will look at the macroeconomic impact and how this plays into the larger game on Wall Street and at the Federal Reserve. And finally, we'll find the counter strategy, how to recognize the trap and move toward financial freedom. This isn't just about theory. This is about real-world, actionable strategies that can redefine your relationship with money. By the end of this video, you will have a clear blueprint for why you might feel poor. And more importantly, you'll know exactly what you need to change to break free. So let's stop blaming everything on the outside and look at what we can control. Let's identify the 8 financial sins that keep us poor. Sin number 1, the illusion of free money, the debt trap. We begin with the most obvious and arguably most destructive sin: high-interest consumer debt. The financial system relies on a certain level of debt to function. Banks make money on interest, credit card companies thrive on minimum payments. For the average consumer, debt is a tool to acquire things now. But in reality, it is a high-cost rental agreement for future income. We all understand compounding interest when it works for us, investments growing exponentially over time, but we rarely truly internalize the power of compounding interest when it works against us. This is the core mechanism of the debt trap. Let's look at the numbers. The average credit card interest rate in the U.S. currently hovers around 21 to 25%. If you carry a balance of $10,000 and only make minimum payments, a significant portion of that payment goes straight to interest. You might pay $250 a month, but only $50 or $60 might reduce the principal. This creates a vicious cycle. Imagine you are in lifestyle creep and you use your credit card to fund an elevated lifestyle. You buy something for $1,000. By the time you've paid it off over several years, that $1,000 purchase may have actually cost you $1,500 or more. The critical psychological trap here is the illusion of free money. When you swipe a card, there is no immediate pain. The pain is delayed until a future date, often months or years away, when the interest has accumulated. This immediate gratification, funded by deferred pain, is the most powerful tool of consumer finance. From a macroeconomic perspective, consumer debt is a multi-trillion-dollar industry that keeps the U.S. economy humming. The Federal Reserve, by managing interest rates, directly influences the cost of this debt. When the Fed keeps interest rates low, it encourages borrowing. The idea is to stimulate economic growth by encouraging people to buy houses, cars, and consumer goods, but this has a side effect. It allows banks to lend more cheaply, and it creates massive profits for credit card companies and financial institutions. Wall Street securitizes these debt streams into investment products. They sell bonds backed by consumer debt, known as ABS or asset-backed securities. The wealthy and institutional investors profit from the high interest payments paid by the average consumer. Here is where the sin becomes truly insidious. The Fed's actions create a situation where good debt, like a mortgage, becomes affordable. But in a high inflation environment, when people's wages can't keep up, they turn to bad debt to bridge the gap. The solution here is a brutal reevaluation of debt. Not all debt is created equal. Debt that generates income or value can be considered good debt. Debt for consumption, like credit cards or personal loans for vacations, is almost always bad debt. To break free, you must implement a debt avalanche strategy. List all your debts from highest interest rate to lowest. Attack the highest interest debt first, paying more than the minimum payment. Once that is paid off, take that money and apply it to the next highest interest debt. The goal here isn't just to pay off debt, it's to break the psychological loop of immediate gratification. The moment you decide to eliminate high-interest debt, you are no longer a consumer renting your lifestyle from the bank. You are an investor taking back control of your future earnings. Sin number 2, lifestyle creep and the hedonic treadmill. We've all heard the phrase keep up with the Joneses, but in the age of social media, the Joneses have multiplied. They are broadcasting their seemingly perfect lives to us 24/7. This creates sin number 2, lifestyle creep. Lifestyle creep is the phenomenon where as your income increases, your spending increases proportionally. This prevents any substantial increase in savings or investment. Let's imagine you get a significant promotion. Your take-home pay jumps by $1,000 a month. What do? The first reaction for most people is to upgrade something. Maybe a slightly nicer car, a bigger apartment, or more frequent dining out. This is a result of the hedonic treadmill. It's a psychological concept where humans quickly adapt to new levels of stimulation. After that, they return to a baseline level of happiness. That new car feels great for a few weeks, but then it becomes just your car. To feel that high again, you need another upgrade, another bigger purchase. This creates a self-reinforcing cycle. As your income rises, you start to believe you deserve more. The problem is, this mindset confuses a high income with true wealth. An investor views a raise as an opportunity to accelerate wealth creation. They do this by increasing savings and investments. A consumer views a raise as an opportunity to increase consumption. The entire Western economy, particularly the U.S. economy, relies on consumer spending. The U.S. GDP is approximately 70% consumer spending. The entire system is built on the premise that you will spend every dollar you earn. Think about the incentives. Marketing is designed to make you feel like you need a new product to be happy. The social pressure created by social media platforms accelerates this process. Lifestyle creep is a critical component of inflation. If everyone's spending rises with their income, demand remains high. High demand for goods and services allows businesses to maintain higher prices. This contributes to the very inflation that makes everyone feel poorer. The solution to lifestyle creep is not deprivation, but conscious decision-making. The rule of thumb for wealth builders is pay yourself first. When you get a raise, immediately increase your investment contribution. Do this before that extra money even hits your checking account. The other strategy is to define your enough. Ask yourself, what level of consumption truly brings me joy? And what level of consumption is simply to keep up appearances? By deciding on your baseline level of happiness, you can redirect extra income. You can move it toward investments that will eventually free you from the necessity of working. The goal here isn't to be frugal, it's to be effective. If you can redirect 50% of every raise toward investments, you are winning. You are effectively cutting the hedonic treadmill in half. This ensures that your wealth grows faster than your consumption. Sin number 3. The scarcity mindset, the belief trap. This sin is less about numbers and more about psychology. It's the belief that money is a finite resource and that there isn't enough to go around. It is the idea that wealth is a zero-sum game where one person's gain must be another person's loss. A scarcity mindset manifests in several ways, starting with decision paralysis. When you believe money is scarce, you become terrified of losing it. This prevents you from making necessary investments in yourself, like further education or starting a business. It stops you from making smart financial moves, like investing in the stock market. The scarcity mindset tells you, I can't afford to save, or it's too risky to invest. It whispers that the stock market is just for rich people. This mindset creates a self-fulfilling prophecy. Because you believe you cannot achieve financial independence, you do not take the necessary steps to achieve it. This mindset also creates a focus on immediate, small savings rather than long-term, large-scale gains. People with a scarcity mindset will spend hours clipping coupons to save $20, but they won't spend 10 minutes researching a low-cost index fund that could earn thousands over a lifetime. They focus on minimizing expenses rather than maximizing income and investment returns. When a large portion of the population operates from a scarcity mindset, it limits economic mobility. A society focused on fear of loss has a hard time fostering entrepreneurship, risk-taking, and innovation. In a healthy capitalist system, wealth creation is not a zero-sum game, it is about creating value. When a new company improves people's lives, it creates new wealth for everyone involved. The scarcity mindset, however, views all successful entrepreneurs as lucky or crooked. It fails to recognize the risk and value creation involved in their success. This mindset is reinforced by media portrayals that focus only on extreme wealth disparities. It highlights the negative aspects of billionaires while ignoring the positive impact of entrepreneurial activity. The solution to the scarcity mindset is to cultivate an abundance mindset. This means viewing money as a tool for value creation, not just a resource for consumption. An abundance mindset focuses on two things: investment in self and value creation. Investment in self means acquiring skills that increase your earning potential. Value creation means finding ways to provide goods or services that are useful to others. Instead of asking, "How can I cut expenses to save $100?" ask a different question. Ask, "How can I create $100 of new value for someone else?" This shifts the focus from limitation to opportunity. It's a fundamental shift in perspective that allows for risk-taking and long-term planning. These are the essential ingredients for true wealth accumulation. Sin number 4, the inflation blind spot: ignoring purchasing power erosion. This is arguably the most common and dangerous sin for people trying to save for retirement. It is the failure to understand that $1 today does not equal $1 tomorrow. Holding cash without growth is a guaranteed way to lose purchasing power. Inflation is a silent tax on cash holdings. If the inflation rate is 3% and your savings account earns 0.5%, you are losing 2.5% of your purchasing power every single year. Over 10 years, that $100,000 will have lost a significant amount of its value. This is why many people find themselves struggling in retirement. Their savings account balance may look big, but the real purchasing power for essentials has shrunk dramatically. This sign also manifests in high-interest savings accounts (HYSAs). While HISAs offer higher rates, they are designed to be temporary safe havens, not long-term wealth builders. When inflation is high, a 5% return on cash might only be keeping pace with inflation. This means you are effectively treading water. Inflation is a direct result of macroeconomic policy. The Federal Reserve has a dual mandate: keep unemployment low and keep inflation stable. To stimulate a struggling economy, the Fed uses tools like quantitative easing. This essentially involves increasing the money supply to buy bonds and lower interest rates. When the money supply increases faster than economic growth, inflation inevitably follows. This is precisely what happened after the 2008 financial crisis and during the pandemic response. The result was massive inflation in assets like real estate and the stock market. This was followed by high consumer price inflation. The Fed's policies are often designed to favor asset owners over cash holders. When inflation runs hot, the value of cash decreases. This forces people to invest in assets just to maintain their wealth. The financial system rewards those who understand this dynamic. Those who keep their wealth in cash are simply watching their purchasing power erode. The solution to the inflation blind spot is to invest in assets that outpace inflation. Over the long term, assets like stocks and real estate have provided real returns. This means understanding the difference between nominal returns and real returns. If you earn 10% on your investments but inflation is 8%, your real return is only 2%. The counter strategy is to calculate your real return constantly and adjust your investments. By investing in productive assets, you are buying a portion of the economy's output. Over time, this increases in value with economic growth and inflation. Sin number 5, the get-rich-quick delusion: speculation over investment. This sin is the opposite of sin number 3. It's not about fear of investing. It's about recklessness. It's the desire to skip the long, boring process of wealth building by chasing speculative fads, meme stocks, and high-risk gambles. The get-rich-quick delusion preys on impatience and FOMO. It's the allure of a large, sudden windfall rather than a slow, steady increase in wealth. This mentality leads people to treat investing like a casino. We saw this play out during the pandemic. Millions of people, stuck at home with stimulus money and free trading apps, jumped into high-risk assets like meme stocks and high-volatility cryptocurrencies. The narrative was simple: a small investment could quickly turn into a fortune. While a few people did get lucky, the vast majority were left holding the bag. The gains were often fleeting and the losses were permanent. This is because speculation is fundamentally different from investing. Investing involves analyzing fundamentals, assessing long-term value, and holding assets for growth over time. Speculation involves betting on short-term price movements based on hype or market sentiment. From a macroeconomic perspective, speculation provides liquidity for institutions and experienced traders. When retail investors pile into speculative assets, they create a massive amount of volatility. Institutional investors can take advantage of this volatility to offload risky positions onto the retail investors at high prices. The U.S. financial system, with its highly liquid markets and advanced trading technology, facilitates this wealth transfer. Day trading platforms encourage high-frequency trading, and social media creates rapid-fire hype cycles. The result is that inexperienced investors often buy at the peak of a bubble and sell at the trough. They end up transferring their wealth to those who understand the market dynamics. The solution to the get-rich-quick delusion is a return to fundamental investment principles. The single most reliable way to build wealth in the U.S. economy is to regularly invest in low-cost, diversified index funds. Index funds track the performance of hundreds of different companies. They eliminate single stock risk. By investing in an index fund like the S&P 500, you are essentially betting on the long-term growth of the American economy as a whole. This strategy requires patience, but it avoids the catastrophic losses associated with speculation. The mindset shift here is from gambler to owner. Instead of trying to guess which stock will go up next week, you should be focused on becoming a part owner of profitable companies. You should focus on companies that will generate value for decades. Sin number 6, the opportunity cost of delay, the power of compounding. This sin is simple but devastating: the failure to start investing early enough. The cost of delay is not just a few missed dollars. It is the entire exponential growth of compounding interest. Let's do a quick comparison that I hope truly hits home. Imagine two people. Investor A and Investor B. Investor A starts investing at age 25. They invest $5,000 per year for 10 years and then stop investing entirely. The money continues to compound until they retire at age 65. Investor B starts investing at age 35. They invest $5,000 per year for 30 years, making a total investment of $150,000. Assuming a conservative 8% average annual return, Investor A's initial $50,000 investment would grow significantly. Investor B, despite investing 3 times as much money, often ends up with less wealth than Investor A. The reason: the extra 10 years of compounding growth for Investor A. The longer your money has to grow, the more powerful compounding becomes. Compounding interest is a geometric function. The growth accelerates as the base amount increases. By delaying investment, you are sacrificing the most powerful years of compounding. These are the years when your money earns money on itself, not just on your initial contributions. The opportunity cost of delay exacerbates the wealth divide. Those with generational wealth are able to start investing earlier. They often inherit assets or receive support that allows them to start saving in their early 20s. This head start, amplified by compounding, ensures they will always be decades ahead. The high cost of living, student loans, and a scarcity mindset contribute to this delay. When young people are burdened with debt, they often feel they cannot afford to save. This leads to a vicious cycle where the rich get richer through early investment. Meanwhile, the less affluent struggle to get started. The counter-strategy for this sign is to start investing immediately, regardless of the amount. Even $50 or $100 a month invested consistently can make a dramatic difference over a lifetime. The most important takeaway from this sin is that your most powerful tool in investing is time. If you are young, your time horizon is an enormous advantage over older investors. If you are older, you must be aggressive in catching up to make up for lost time. This means prioritizing investing before lifestyle creep takes hold. Make a commitment to invest a portion of every paycheck before you spend any of it. Sin number 7, financial illiteracy and delegation. This sin is not about intelligence. It's about education and accountability. Financial illiteracy is the failure to understand basic financial concepts. Delegation is the sin of trusting others with your money without understanding what they are doing. When you don't understand how money works, you become a victim of those who do. Financial illiteracy costs people in 3 main ways, starting with high fees. Not understanding expense ratios on investments can seem small, but the impact is huge. A mutual fund with a 1.5% expense ratio can eat up tens of thousands of dollars in gains over 30 years. Low-cost index funds often have expense ratios as low as 0.03%, and the difference is monumental. The second cost is tax inefficiency, not utilizing accounts like 401ks, Roth IRAs, and HSAs. The U.S. government provides massive tax benefits, yet many people either don't know about them or don't utilize them fully. The third cost is bad advice, falling for scams or trusting high-fee financial advisors. These advisors often prioritize their commission over your best interests. They sell complicated products like annuities or whole life insurance to people who don't need them. The financial industry thrives on complexity. When financial products are complicated, it creates a need for middlemen who take a cut of your money. The U.S. financial system is designed to be difficult for the average person to navigate. Financial illiteracy contributes to the wealth gap. It allows those in power to extract wealth from those who lack the knowledge to protect themselves. The complexity of products like derivatives highlights how an educated few can profit from the ignorance of the many. The solution to this sin is to take full ownership of your financial education. This doesn't mean becoming an expert trader, it means understanding the basics. You need to understand how compounding interest works for you in investing and against you in debt. You need to understand tax-advantaged accounts and the difference between traditional and Roth options. You need to understand expense ratios and why low-cost index funds are often the best choice for beginners. The shift here is from passive delegation to active participation. If you work with a financial advisor, ensure they are a fiduciary. This means they are legally obligated to act in your best financial interest, not their own. Sin number 8, the underinsurance gamble. Catastrophic risk exposure. This sin is about preparing for the unexpected. Wealth building is not just about growing your assets. It's about protecting them from catastrophic loss. The sin of underinsurance is the failure to create a financial safety net against unforeseen events. In the U.S., one of the leading causes of personal bankruptcy is medical debt. A sudden illness, injury, or natural disaster can wipe out years of savings if you are not properly insured. This sin manifests in 3 key areas, starting with having no emergency fund. An emergency fund of 3 to 6 months of expenses acts as a buffer against unforeseen events. Without it, a sudden car repair or job loss forces you back into high-interest debt. This completely derails your financial progress. The second area is inadequate health insurance. Choosing high-deductible plans without a corresponding HSA or sufficient savings is a major risk. A single hospital stay could lead to tens of thousands of dollars in out-of-pocket costs. The third area is underinsuring assets, like not having sufficient homeowners or renters insurance. A fire, theft, or flood can destroy assets that took years to acquire. The U.S. healthcare system is unique in that it ties healthcare to employment. It often requires individuals to bear significant portions of risk. This system creates systemic risk for the entire economy. When a large segment of the population is vulnerable to medical bankruptcy, it destabilizes communities. It also puts heavy pressure on government-funded social programs. The high cost of health care forces individuals into difficult choices. People have to choose between saving for retirement and paying for immediate health care needs. This dynamic creates a society where one illness can undo a lifetime of work. It reinforces the feeling that hard work alone isn't enough to secure financial stability. To avoid this sin, you must build a financial fortress around your existing assets. This starts with a fully funded emergency fund in a high-yield savings account. This money is not for investing, it is strictly for safety. Next, you must assess your risk exposure and ensure adequate insurance coverage. This includes health insurance and disability insurance to protect your income. It also includes term life insurance for your family and property insurance for your assets. The goal here is not to be paranoid, but to be realistic. Wealth building is a marathon. You need to ensure you don't get knocked out of the race by a single catastrophic event, so let's bring it all together. We've discussed the 8 financial sins that keep people poor, even high-income earners. We've talked about debt, lifestyle creep, scarcity mindset, inflation, speculation, delay, ignorance, and risk exposure. You might be asking yourself, Bogdan, where do I start? The answer is simple. You have to change your relationship with money. You have to move from being a consumer to being an owner. A consumer's default setting is make money, spend money, use debt to fill the gap. An owner's default setting is make money, invest money, spend what's left. The average person views money as a tool to acquire things. The wealthy view money as a tool to acquire assets that produce more money. Let's look at how these sins interact through the story of Sarah. Sarah graduates college with student loan debt. She gets her first job with a good salary and immediately falls victim to lifestyle creep. She upgrades her apartment and car to match her new income. She carries credit card debt because she doesn't know any better, mixing illiteracy with bad debt. When she finally saves a little money, she jumps into a high-risk crypto coin and loses most of it. She struggles to save for retirement because she started late and believes she can't catch up. Suddenly, a medical emergency hits, wiping out her remaining savings because of underinsurance. She's back at square one, feeling like she's on a hamster wheel. And she blames inflation for all her problems. Do you see the cycle? Do you see how each of these sins reinforces the others, creating a powerful trap? The solution isn't to be a perfect ascetic. It's to be a strategic financial combatant. It's about recognizing the psychological traps and deciding to play a different game. Here's a summary of the action plan. First, eliminate high-interest debt as your priority using the debt avalanche method. Second, practice conscious spending by investing your raises before upgrading your lifestyle. Third, invest in yourself to acquire skills that increase your earning potential. Fourth, invest for real returns in assets that grow faster than inflation. Fifth, focus on long-term investing and avoid speculative bubbles. Sixth, start now to take advantage of compounding interest even with small amounts. Seventh, educate yourself about tax-advantaged accounts and minimize fees. And eighth, build a financial fortress with an emergency fund and proper insurance. This is not a quick fix, it is a framework for changing your financial destiny. By addressing these 8 sins, you are taking back control of your financial life. The American economy today is built on innovation and asset ownership. The challenge is to make the jump from being a passive consumer to becoming an active owner. This isn't a battle against the rich. It's a battle against a system that rewards short-term gratification. The choice is yours. You can continue to play a game where the odds are stacked against you. Or you can start playing the game where time and compounding interest are your allies. I want to hear from you. Which of these 8 sins do you feel has had the biggest impact on your financial life? Are you currently struggling with a scarcity mindset, or are you fighting off lifestyle creep? Let me know in the comments below. Thank you for watching, and I hope this provided a valuable new perspective. I'm Bogdan, and I'll see you in the next video.